If you've studied basic price action, you know the standard drill. You wait for a stock to test a downward trend line, watch for the breakout, and then you buy. It's what everyone is taught. But by the time that breakout happens, you've already missed the most profitable part of the move. The largest, most predictable price action actually takes place while the price is miles away from that line. A valid trend line exerts a massive gravitational pull on the market. When the price gets stretched too far, it snaps right back toward the line like a rubber band. To use this, we need to follow 4 strict rules. Rule 1 is validity. The trend line must have a clear history. We need to see the price touch this line and reject it cleanly, multiple times. If the market hasn't respected the line in the past, it won't act as a target in the future. Rule 2 is distance. Something needs to have shocked the market to push the price aggressively away from that established line. This could be a massive earnings miss, a sudden war, or a major unexpected political event. The exact reason doesn't matter. What matters is that the price is now completely detached from the trend line it used to hug. Rules 3 and 4 dictate our entry and exit. We don't just buy because the price is low. We wait for the price to hit a historically strong demand zone and show exhaustion. Once we get that confirmation, we enter. Our primary take-profit target is the distant trend line itself. Viewing charts this way reveals a hidden logic. These trend lines are inevitable gravitational targets. Once a market imbalance becomes extreme, the price is eventually forced to revisit these historical destinations. Let's apply this to a realistic bearish scenario. A stock has suffered a massive sell-off. The price has plummeted far below our valid, established upper trend line. The distance rule is met. This creates a dangerous temptation, the gravity trap. You see the huge gap and think the asset is cheap, but buying simply because a price is far from its trend line is a great way to catch a falling knife. Downward momentum will easily crush premature entries. Patience is how we survive this. We have to let the price keep falling until it hits a historically verified demand zone. Even then, we wait. We need the market to print a confirmed reversal pattern inside that zone, like a W pattern or a bullish engulfing candle. That is our signal. Once that reversal at the demand zone is confirmed, we have our setup, and we know exactly where the move is headed. The very first take-profit target is drawn straight up to that distant trend line. By pairing the extreme distance of a market shock with a precise reversal at a demand zone, we replace guesswork with a calculated high-probability setup. Reaching the trendline target is a victory, but it introduces a new danger. Many traders buy right here, expecting a massive breakout. Instead, the price pokes slightly above the line, traps the buyers, and violently reverses downward. To protect our profits, we use the left side check. Whenever the price nears our trendline target, look to the left side of your chart's history. You are searching for any older, untested supply zones that line up exactly with where the price is hitting the trend line today. If you see a strong supply zone sitting right at your target intersection, the decision is made for you. Do not hope for a breakout. Take your full profits at the trend line and step aside. Look at this chart. The price is floating right in the middle. It is far away from the trend line above, but it hasn't reached the demand zone below. Do you enter a trade here? The answer is no. Taking a position in the middle of nowhere, without a confirmed zone backing you up, is purely gambling. We need structure. Historical context on the left side of your chart is the ultimate judge of whether a setup on the right is actually safe to trade. While trendline theory helps us capture macro moves, we can apply this same magnetic concept on a micro level. We just have to zoom all the way in to a 1-minute intraday time frame. Here, we are looking for an imbalance, or IMB. Look closely at 3 sequential candles. If you see a literal empty, untraded space between the wick of the first candle and the wick of the third candle, you have found an imbalance. This is different from a standard daily gap up on the opening bell. This is an intraday vacuum created during live trading. The market hates leaving this kind of untraded space, and it inherently wants to fill it. So how do we trade this? When your price bounces off a valid demand zone on a lower time frame, look above you. These 1-minute gaps become highly reliable, immediate targets for taking partial profit. Trend lines dictate the macro journey, but 1-minute imbalances provide the micro stepping stones to secure early profits. Let's bring this all together into a single trading plan. Here is our ideal scenario.
We have a green demand zone at the bottom, a 1-minute imbalance gap in the middle, and our major red trend line floating far overhead. Our execution starts at the floor. The price drops into our historical demand zone, and a bullish reversal confirms our entry. We are in the trade. As the price moves upward, it acts like a magnet toward that micro vacuum. The moment the price fills the 1-minute gap, we take a portion of our position off the table, securing our first partial profit. With our risk reduced, we can comfortably hold the remaining position. We let the macro gravity of the chart take over, riding the move until the price is finally pulled straight into the main trend line for our final exit. Here is your framework. Find valid trend lines with history. Wait for extreme distance and a confirmed demand zone entry. Use the left side of your chart to spot hidden supply zones. And use 1-minute gaps to bank early profits. Open your charts right now and find just one 1-minute gap. See how the price reacts to it. If you want more step-by-step price action setups, hit subscribe, and we'll see you in the next breakdown.